Replace emotional operations with standardized transactions, the priority of market factors in macro analysis. Here is Alpha, an investment philosophy of non-professionals. There are too many factors that affect the market, as many as the stars in the sky. It is impossible for us to quantitatively evaluate the impact of each factor. In fact, there is no need for us to do this work. What we need to do is to simplify these factors as much as possible. Use the first principle to grasp the most critical part of them, and make the factors worth considering as few as possible. The video on this topic is a sharing of my personal investment philosophy that I have been thinking about for a long time. The content is about the main framework of my personal trading system. Some people may ask, if a reliable trading system has been built, can I make money quietly? Why do I have to open a channel to share it? First of all, I want to state that all the trading concepts in this channel are my personal opinions, not a set of money-making tools that can be used directly. But it can provide you with a set of logic for understanding the operation of the market, a unique perspective for observing the market, and some potential market opportunities. Why do I want to make these valuable contents public? This is what I think. First of all, this channel is a life log for me, a record of part of my life journey. Then, I think it is very interesting to create original content. It not only gives people some emotional rewards for self-entertainment, but also is a process of self-examination. When putting ideas on paper, it helps to find problems and sort out thoughts, which can make me do better in investment. Finally, if this video can provide investors with some valuable information and get attention and advertising fees, even if this part of the fee is only enough to pay the electricity bill, I will feel very happy. Since this public channel is created, I definitely hope that the more traffic the better. But I will not please the audience for traffic, because the traffic obtained by pleasing will not last long. I think the process of doing self-media should be a process of mutual screening between the channel and the audience. The final result is that it naturally reaches a stable state of people are divided into groups. What I think is how this channel speaks, and I try my best to speak out useful content in an interesting way. But this way, with my limited personal level, obviously cannot become the mainstream of traffic. But it doesn't matter, just be real. Let's get back to the point. The theme of this series mainly discusses two aspects. On the one hand, it is macro analysis, how to classify and prioritize the macro information of the market. On the other hand, it is micro analysis. It consists of two parts, fundamental analysis and technical analysis. I tried to explain the concept in a simple and clear way, and try to talk less about pure mathematics. We know that content with too strong a mathematical formula will make both the narrator and the audience feel bored. Okay, I will start the first part. How to classify and prioritize market information. How do we find direction in the pile of various information in the stock market? Every day when you open your mobile phone, the news screen is full of good news and bad news. The Federal Reserve has raised interest rates, a company's performance has exploded, the golden cross indicator of the K-line has appeared again, and geopolitical conflicts have escalated. There is so much information that it is dazzling. If we take all these news seriously, we will only make ourselves dizzy in the end. So we need to have some rules, classify and line up the information, and figure out which ones are mountain pressure, and which ones are drizzle. Here, I will take you to split the market information from two major perspectives. One is the capital side, and the other is the emotional side. Next, let's officially start our discussion. What kind of macro events are the compass in the information torrent? The market is like a big and bustling bazaar, with news flying all over the sky, some true, some false, some big, some small. If we believe everything and grab everything, we will end up with nothing. We need a clear framework to deal with the torrent of information, so as to determine whether these factors have a positive or negative impact on the market, and whether the impact is large or small. From the perspective of the reasons that affect the market, we can divide macro information into two categories, capital and emotional. Capital factors are the driving force for transactions and the cornerstone of the market. They determine the direction of the long-term trend of the market. Emotional factors are catalysts that accelerate the market's heartbeat in the short term. They can stir up waves for a period of time, but they will not determine the long-term trend direction. Next, I will disassemble these two categories of information in detail, classify and prioritize them, and illustrate them with the case of the U.S. stock market. First of all, we say that the capital side is the stabilizing force of the long-term trend. The capital side is the lifeline of the market, which directly affects the flow of funds and long-term performance. It covers the macroeconomic policy environment, industry trends, and the fundamentals of the company, and is the core factor that determines the healthy development of the market. We divide the capital side into three categories, from large to small, layer by layer. The first category is the capital side information at the macro level. The aorta that affects the overall situation is the top-level information, with a wide coverage and strong lethality, which can influence the general direction of the entire market. First, geopolitical risk. We will give it a level of importance, 5-star. Geopolitical risk is the biggest time bomb. Once it explodes, the entire market will be impacted. For example, the outbreak of the Russian-Ukrainian war in 2022 caused a fall in the U.S. stock market. The S&P 500 fell by about 10% in the early stages of the conflict, and soaring energy prices pushed up inflation expectations. Investors sold stocks and turned to safe haven assets such as gold and the U.S. dollar. Energy giants like ExxonMobil made short-term gains, while technology stocks, such as the Nasdaq index, fell by more than 15%. At this time, geopolitical risks are long-term negative, and funds will choose to take refuge first. We must pay attention to these news as soon as possible, and such news must attract our 120% attention. Second, monetary policy is also 5-star in importance. The Fed's monetary policy is the baton of the market. Interest rate hikes and cuts, quantitative easing, tightening, they all directly affect the liquidity of the market. In 2022, the Federal Reserve continued to raise interest rates, and the federal funds rate rose from near zero to more than 4%, and the market capital cost increased significantly. Highly valued technology stocks were the first to be affected. The stock prices of giants such as Apple and Amazon quickly fell back, and the Nasdaq index fell by more than 30% throughout the year. In turn, after the 2008 financial crisis, the Fed launched QE and the S&P 500 rebounded from the bottom, ushering in a 10-year bull market. Monetary policy determines the long-term tightness of funds, and it ranks first with geopolitical risks. Third, fiscal policy, 4 stars in importance. The government's fiscal policy can also stir up waves. In 2017, the Trump administration launched a large-scale tax cut policy, reducing the corporate tax rate from 35% to 21%, which greatly improved the profitability of companies. The S&P 500 rose by 20% between 2017 and 2018. During the COVID-19 pandemic in 2020, the U.S. government launched another $2 trillion rescue plan. The stock market quickly rebounded from panic, and the Dow Jones Index rebounded by nearly 40%. So we say that fiscal policy is the engine of funds, and its importance is second only to monetary policy. Fourth, regulatory policy, with a 4-star importance. Regulatory policy can turn an industry from heaven to hell, or from hell to heaven. The 2010 Dodd-Frank Act strengthened supervision of the financial industry. Large banks such as Morgan Stanley were under short-term pressure, and stock price fluctuations increased. In 2021, the Biden administration promoted green energy policies, and new energy companies such as Tesla benefited, with stock prices hitting new highs. Regulatory policy directly affects the flow of funds, and it is as important as fiscal policy. Fifth, natural disasters and epidemic emergencies, with a 5-star importance. Natural disasters and epidemics are unpredictable. Black swan events can quickly disrupt the rhythm of the market. The outbreak of the COVID-19 pandemic in 2020 disrupted the global supply chain, the U.S. stock market plummeted, and the S&P 500 index fell 34% in March. After the 2011 earthquake in Japan, the Nikkei index fell by more than 10% in the short term. These events directly affected the economic fundamentals and the direction of capital flow, and are at the same level as geopolitical risk monetary policy. Sixth, unexpected policies, such as tariff wars, are 4 stars in importance. Tariff wars can change the pattern of trade and affect corporate costs and profits. In 2018, the Sino-US trade war escalated. The United States imposed tariffs on Chinese goods, Apple's supply chain was impacted, and stock prices fluctuated violently. Although the Fed's interest rate cut provided some support, the S&P 500 still fell to 2,350 points. And in 2025, Trump's second term began. On April 2, Trump implemented the Liberation Day Plan, which greatly escalated the tariff war and caused a sharp drop in the stock market. This shows that tariffs are a major variable on the capital side, and their importance is comparable to fiscal policy. The second category, information on capital at the industry level, which can determine the prospects of the entire industry. After talking about the macro environment, look at information on the industry side, focusing on the capital movements of specific sectors or representative listed companies. First, the trend of industry development, with a 4-star importance. Choosing the right industry is like standing on the vent. In the past decade, the technology industry has been far ahead in the US market. Facebook, Apple, Amazon, Netflix, Google and other companies have led the Nasdaq index to double. In the future, AI and related automated robotics industries may be new outlets. Tesla's stock price has increased nearly 10 times from 2020 to 2021. On the contrary, the coal industry has gradually declined and the stock prices of some energy companies have been sluggish for a long time, so we say that industry trends are the vein of capital. Second, policy support, 4-star importance. Government support can make the industry take off. In 2021, the Biden administration launched the infrastructure bill, investing $550 billion to support new energy and infrastructure. ChargePoint's stock price is large, and the traditional automotive industry has been marginalized. Policy support is a booster for the industry's capital side, which is equally important as industry trends. The third category, company-level capital information, which can help us pick out high-quality targets. After talking about the industry, let's look at specific companies and focus on the long-term value of individual stocks. First, wealth status, 3-star importance. Through the company's physical examination report, balance sheet, income statement, and cash flow statement, we can see whether they are healthy. Apple has more than $100 billion in cash on its account, and has strong risk resistance. The bankrupt Hess car rental collapsed due to high debt. Financial status is the basis of the company's capital, and a good financial status can attract more long-term funds to stay in the stock. Second, profitability, 3-star importance. Gross profit margin and net profit margin reflect the company's ability to make money. Google's advertising business gross profit margin exceeds 50%, and its stock price is strong. Walmart's profit margin and stock price also fluctuate less. Profitability determines whether the company's stock can continue to attract incremental funds to enter the market. For example, speculative funds that seek short-term gains, or investment funds that are keen on high gross profits. Third, growth, 3-star importance. Companies with fast-growing revenue and profits have more room. Amazon's stock price doubled thanks to its AWS business, and Netflix became the darling of the market thanks to its subscription growth. Growth is a reservoir for funds. The company's growth has become almost the most important factor in fundamental information and is the target of smart money. Faced with a new track that is rapidly emerging, everyone wants to be an early holder of such stocks. The rest can be left to time. Let's briefly summarize that although the factors on the capital side cannot be directly related to the rise and fall of each day, it is the stabilizer of the long-term trend and a basic issue that long-term investors must pay attention to. Next, we will sort out the emotional factors. Okay, let's stop here. We will continue in the next issue.